Okay, now so far we have talked about this, how a bank operates. Yesterday we talked about how banks create credit. And what is credit? Credit is basically the loans that banks create, right? So credit creation is a complete process through which commercial banks in an economy create loans. And through that, people borrow money, or institutions or companies borrow money to invest, and so on and so forth, right? We understood the entire process of credit creation, where we looked at this idea that credit creation or credit multiplier is equals to 100 divided by liquidity ratio. So if liquidity ratio is lower, which means that, what is liquidity ratio? Liquidity ratio is the percentage of deposits that a bank has to set aside, and that could not be used to issue loans, right? So liquidity ratio is the proportion of deposits that are kept in the form of cash with the bank in case the depositors come and they want to claim their money, right? So that is credit multiplier. Right. So who decides liquidity ratio? Liquidity ratio in an economy is decided by the central bank, right? On the other hand, if liquidity ratio is higher, this means that your credit multiplier will be lower, and therefore banks cannot create as much credit or as high amount of loans as much they could have otherwise, right? Okay, so we understood the idea of credit creation. We looked at some examples, we looked at the definitions and all that stuff. Then towards the end of yesterday's class, we started off with this new topic within money market, which is open market operations. So we'll do a recap of that. And then in today's class, we'll complete off with this topic, open market operations. Now think about this. So just like commercial banks affect the money supply of an economy through creation of loans. Now listen to this very carefully. Just like commercial banks, right, which are private banks, normal private banks, which are there for profit-making purposes. So credit creation was the process how commercial banks create credit, create loans, and therefore they affect the money supply of a country. Now in today's class, when we discuss open market operations, we are looking at how government, right, how government affect countries' money supply, right? So we'll see how government is involved in open market operations, what it is exactly, how government affect money supply of an economy, right? Is it making sense? Okay, now yesterday we started our discussion, just a second. Right, so how government affect money supply of an economy, right? Okay, now yesterday we started our discussion with the idea of bonds. What are government bonds, right? So government bonds, or just like bonds, are instruments, are certificates that show the loan that someone has raised, right? So when we talk about government bonds, what we basically mean that government issue bonds to general public, right? Anyone can buy government bonds, and the amount that the bond is for, that is technically the amount that the government has borrowed from those people for a certain time period, and after that time period, the government will return the principal amount, right? The amount that was initially given to the government by the individuals along with the interest, right? Just like any normal loan transaction, what happens is that after a certain time period, whoever borrowed the money has to return back the principal amount plus interest, right? So just like that, in the case of government bond as well, government is borrowing money from individuals, general public, and after a certain time period, the government will return back their money with interest, right? So that's the idea. Now think about this. The way it happens is that there are technically three parties involved, right? So there's a central bank, which basically prints government bonds on behalf of the government. Then there are commercial banks, right? So commercial banks are normal private banks, and commercial banks deal with general public, right? Central bank doesn't deal with general public. We do know that, right? And then there are individuals, or general public, you can just simply write, right? People who want to buy government bonds, right? General public. Okay, now think about this. So the way it happens is that the central bank will print bonds, they will give to the commercial banks, right, to sell these bonds to the general public. And then through commercial banks, these bonds come to the general public, right? So general public buys bonds through commercial banks. And in return, what happens? In return, the money is flowing from the general public, right? So money is flowing from the general public through obviously commercial banks to the central bank, right? So money is going to the government, or the central bank, and bonds are going to the general public, right? Now, this is when the first time government sales, or this is known as sale of bonds, right? So this is sale of bonds, right? So think about this. When sale happens, what happens? General public has bought the bonds, and the money has moved from the general public from the general public to the central bank, right? So this is the first time that bonds are sold in the market. Okay. Now this is the point where we stopped in yesterday's class, and now I'm about to tell you something new. Now, please think about this. When money is going out of commercial banks to the central bank, right? General public, like think about this. There is any individual, right? Let's say I had my bank account in a commercial bank, right? And I decided to buy bonds worth 40,000 rupees, right? So I decided to buy bonds worth 40,000 rupees. Now, this amount would be deducted from my bank account because I'll be paying the money that is lying in my commercial bank. Most of the times, this is how it happens. My money, extra money is lying in my bank account. So I decided to make that investment in bonds and government bonds. So I bought bonds worth 40,000 rupees. So my bank account would decrease by 40,000 rupees, and that money would go to the central bank, and that money will become available to the government, and the government would invest it in different projects like building roads, education, healthcare, and so on and so forth, right? Now, what effect will this have on commercial banks? When bonds are being sold to the general public, what effect will this have on the deposits of commercial banks? Can you guess? Right? Preet, can you guess what effect will sale of bonds have on the deposits of commercial banks? Any idea? What do you think? So when my money that was lying in my commercial bank account, right, in my bank account, simply speaking, was used to buy government bonds, then what would it do to the deposits of that bank? Obviously, the deposits would decrease. Yes or no? Do you agree with me or not? The bank deposits will decrease because that money is no more available with that bank, because that deposit has been transferred from the commercial bank to the central bank, right? This is how it happens. Yes or no? Is it making sense? Now with that happening, when deposits are reduced, what will happen to commercial banks' ability to lend? How would decrease in the deposits affect commercial banks ability to lend? What do you think? Would that increase? Would that decrease? Would that stay the same? Right? So obviously we do know that commercial banks' ability to lend would decrease, because with lesser deposits, we know the entire process of credit creation, right? So with lesser deposits, there will be a lesser amount available to issue loans, and with lesser amount to issue loans, there will be lesser amount of loans overall issued in the economy, right? Is it making sense? Is it making sense? Right? Breathe. Okay. Now, when this happens, so sale of bonds will reduce commercial bank deposits. When commercial bank deposits are reduced, commercial bank's ability to lend decreases. Commercial bank's ability to lend decreases, and therefore there will be less loans available in the economy. Right? Is it making sense? Now, with this happening, when there are less loans issued, how will that affect the interest rate? So what I'm simply asking here is that how sale of government bonds will affect interest rates. Now you might be wondering how interest rates came into the picture. How sale of government bonds will affect interest rates, right? And think about this. Now going back to the two theories of interest rate determination that we studied at the start of our money market topic, right? One was loanable fund theory, and the other one was liquidity preference theory. Loanable fund theory said, let me give you a quick recap. Loanable fund theory, right? And liquidity preference theory. So we are talking about the first theory, which is loanable fund theory. So loanable fund theory had a very simple idea that interest rates in an economy are determined by market forces. And what are these market forces, right? The market forces of demand and supply. Demand supply of what? In this case, since we're talking about loans, right? So since we're talking about loans, so obviously it should be the demand supply of loans. So quantity of loans will be on the x-axis, interest rate is on the y-axis, right? Where the demand supply of loans is equal, that is where the interest rates are, right? So simply downward sloping is your demand for loans. Simply, simple upward sloping is the supply for loans, where the supply and demand for loans are equal. That's the equilibrium point in the market, and that determines the equilibrium interest rate. Is it simple, Preet? Is it making sense, right? So what it means basically that with lower loans being issued, right? What will happen to the supply for loans? The supply of loans will decrease. The supply of loans, I'll give you a recap, right? So supply of loans will decrease. So with that happening, the supply of loans shifting to the left, because now commercial banks have less deposits and therefore they can issue less loans. And when they issue less loans, supply of loan decreases, and that results in an increase in interest rates. So let's look at this entire, uh, you know, channel. Let's look at this entire system one more time. Okay. Now we started our discussion with the idea that what is open market operation, right? So I said open market operations is basically the idea that explains how government affects the money supply of an economy, right? And we do know that government or the central bank is responsible. The central bank is responsible for the printing of currency notes, right? So far, we haven't discussed where the currency notes are being printed. We are just about to discuss that. So don't worry about it at the moment. Again, what is open market operations? Open market operations is the mechanism that explains how government of an economy affect the money supply of that country. Okay, now think about this. Open market operations is about sale and purchase of bonds. Open market operations, if I have to write it down over here, right? Open market operations is about sale and purchase of bonds, right? Okay, now the first step is obviously to sell bonds, right? So the first step is that the government wants to raise loan internally from its citizens, and therefore it will issue bonds. Market operation is about sale and purchase of government bonds. Sale and purchase of government bonds. Is this simple? Is this easy? Okay. Now, in the first step, when government is selling its bonds, right? So sale of bonds. What's the process? So central bank is the one that's printing government bonds. Then central bank doesn't directly deal with the general public. So what it needs to do, it has to engage commercial banks. So central bank prints government bonds, and then through commercial banks, it sells to the general public, right? So you can see that the bonds are flowing from central banks through commercial banks to the general public. And in return, the money is flowing from general public through commercial banks to the government via central bank, right? This is the process. Now, when this money becomes available to the central bank, obviously that money belongs to the government because government has raised a loan from the general public. So the government will make use of this amount to do some of its projects, like I don't know, implementing an infrastructure project, or to spend more money on education or healthcare or things like that, right? This is how the process works. Okay. Now, what I was saying over here, think of one individual, right? Think of one person, let's say Qasim. So I had some extra money lying in my commercial bank account, right? Or simply speaking, my bank account. So I had some extra money lying in my bank account with which I decided to invest in government bonds. So with the extra money that was lying in my bank account, I decided to buy government bonds. So what will that do? That the amount lying in my commercial bank has now been paid to the central bank because I've bought bonds against that money, right? So commercial bank deposits have decreased. So when general public buy government bonds, commercial bank deposits decrease because obviously people are paying for those bonds through the money that was lying in their bank account, right? Now, we do know that through the idea of credit creation, that we discussed yesterday, we know when commercial banks deposits decrease, what happens? Commercial banks' ability to lend decreases. Commercial banks' ability to lend decreases, right? Because deposits are lower, so now they can, issue less amount of loans. So now, when the amount of loans that are being issued decreases, right? That's the first thing. Then the second question I asked you that how will this affect interest rates? How will this affect the interest rates? This will affect the interest rates in the way that, think about this, according to this theory that we studied, the very first topic within money market that we studied was the idea of how interest rates are determined, right? How interest rates in an economy are determined. And within that, we studied one of the two theories that we studied was loanable fund theory, right? And the other one was liquidity preference theory, but I'm explaining you with the help of loanable fund theory. Now, think about this. Loanable fund theory had a very simple idea that interest rates in an economy are determined on the basis of market forces, which are market forces of demand and supply. So how much is the supply for loans? How much is the demand for loans, right? Where the demand supply are equal, that is equilibrium point. That is equilibrium interest rates, right? So initially, the original supply of loans, which is determined by commercial banks, right, was S1, right? So the initial supply of loans was S1, and the initial demand of loans by consumers, firms, companies who want to borrow was D1. Now, with lesser deposits, since commercial banks will be able to issue lesser loans, therefore the supply of loans, has shifted to the left, to this new supply curve S2. Now, this new supply curve S2 is intersecting with this demand curve D1 at this point, and you can see that the equilibrium interest rates have increased from I0 to I1, right? So the long story short is that whenever government will sell its bonds, so whenever government sell its bonds, right? So loans amount will decrease, less loans will be issued by the commercial banks, so it will have two effects. Lesser loans issued by commercial banks, and as a result of this, the interest rates will increase. Easy, right? And since there are lesser loans, obviously, there will be higher interest rates. We know this. Because lesser supply of something means higher prices. And in this case, what's the price of loans? Interest rates, right? So higher interest rates. Okay, now we'll look at the other side of the transaction, higher interest rates. The other side of the transaction is that obviously whenever government sell its bonds, right, it has to purchase those bonds back and pay back the consumers. Yes or no, right? So it's not just about credit, right? So it's not one-sided transaction. Obviously, when initially the government has sold its bonds to the general public, then after some time, when the bonds mature, what's the terminology that we use? That when bonds will mature, right, the government has to purchase back these bonds. So when government purchases back these bonds, so this entire transaction that we looked at will reverse. Purchasing back bonds. Is it making sense, right? So initially bonds were sold to the general public made their investment in government bonds, government made use of that money to invest in different projects, to do whatever it wanted to do. Now the maturity date has come, let's say 5 years, 10 years, different type of bonds have different maturity dates. They're short-term bonds, they're long-term bonds, and so on and so forth, right? So whatever the duration of that bond was, whatever the maturity date of that bond was, 5 years, let's say, that has that time has completed, and now the government has to purchase back those bonds. Okay, now again, the three parties will be involved, but the nature of transaction will reverse, right? So there's commercial bank in the middle that is connecting the two parties, central bank on one side and general public on the other side, right? Now, central bank, and then you have general public, right? Okay, now the bonds will flow from the general public to the central bank, right? Now, since the government is buying back those bonds, so the bonds will flow from the general public via commercial banks, right, to the central bank, right? Okay. And in return, the central bank will pay back the money of general public to them, right? So the money will flow from the central bank via commercial banks to the general public. Easy. Is this simple, Preet? So this entire transaction has reversed compared to what it was initially, right? So bonds initially were flowing from the central bank to the general public, and money was flowing from general public to the central bank. And now in this case, it has reversed, that bonds are flowing from general public to the central bank and money is flowing back to the general public. Okay. Now think about this. When my investment in the bonds have matured, I received my money back, right? So let's say I was taking this example of this individual, right? Let's say it was me. So my investment in bonds, which was, let's say, 40,000 rupees, has been, what's that called? Reimbursed or whatever, right? I have received that money back. Now, this 40,000 will come to my bank account, right? Which means that my commercial bank account amount has increased. So the commercial bank in which I have my bank account, the deposits of that commercial bank has increased. Yes or no? Just like initially when I bought government bonds, the money that was lying in my bank account was used to pay for the bonds, and therefore the deposits of that commercial bank decreased. Now the reverse of that is happening, and therefore the deposit of the commercial bank has increased. Easy. Should be simple, right? Okay, great. Now with more deposits, we can imagine what will happen. With greater amount of deposits available to the commercial bank, obviously its ability to lend loans has increased, and therefore it can issue more loans. So when there are more deposits now available to the commercial bank, it can issue more loans. And when more loans will be issued, what happens? The interest rate decreases. What happens? The interest rate decreases by the same logic that we discussed, that with greater supply of loans. In this case, what will happen? Right? In this case, when more loans will be issued, think about this, right? Let's choose a different color. Look at this. So again, using the loanable fund theory, right? So you have interest rates on the y-axis, you have quantity of, you have interest rates on the y-axis, you have quantity of loans on the x-axis, quantity of loans on the x-axis, and then you have downward sloping demand for loans, you have upward sloping supply for loans, and where the two intersect, supply and demand, right? That's the equilibrium point. Now, with more deposits coming, with more deposits available to commercial banks, they can obviously issue more loans, and the supply of loans will shift to the right like this, and interest rates decrease. Easy. Is it simple? So that's the entire process. Another name for this idea, another name for this transaction is known as quantitative easing, right? So why am I explaining you? Why am I telling you this? I'll tell you in a bit, right? So another name for this is known as quantitative easing, right? So when the government is purchasing back bonds, it's also known as quantitative easing. And this is linked to the idea that it will reduce interest rates in the economy. So it will reduce interest rates in the economy, right? Quantitative easing, right? So think about this. Whenever you come across this word quantitative easing, do remember that the government is buying back its bonds, and this entire mechanism will take place, and due to that, the interest rates in the economy will decrease, right? Now, there are two ways of going around this. Either you can just memorize this final thing, right? Either you can just memorize that in the case of sale of bonds, lesser amounts of loan will be issued by the commercial banks because their deposits have decreased, and there will be higher interest rates because lower amounts of loans are being issued. Either you can just memorize this final part, or if you completely understood this entire explanation that I gave you, it would be better if you have this entire mechanism process in your mind, and you can recall it later on, right? But even if you cannot, and if you think that it's too much to remember, then at least you have to remember this main part. And similarly, when the reverse of this happens, when the reverse of this happens, when the government is purchasing back the bonds, so you have to remember this final thing that deposits will increase, loans will increase, and interest rates will decrease. Got it? Okay. Now, this being clear, right, we will move on and discuss the final topic of money market, which is quantity theory of money. Now, the final topic of money market is quantity theory of money, right? Okay. Now, what is quantity theory of money? I'll tell you. It's basically a model that explains that how much money should be available in an economy, right? So, what is quantity theory of money, right? Quantity theory of money is a model, is a model that explains how much quantity of money should be available in an economy, right? Why is this important? We'll see in a bit. How much quantity of money should be available, should be available in an economy, right? Okay. Now think about this. Now, this is a very simple mathematical formula kind of a thing. But before we jump to that mathematical equation, mathematical formula, right? What we need to understand that what's the purpose of money, right? Now, in our very initial classes, we talked about that money is anything that helps you, any instrument, any commodity, right? Let me write this down so that you could remember. Um, any instrument, any commodity, right, that is used to buy goods and services, right? That's the ultimate purpose, that's the ultimate function of money. Commodity that is used for making transactions, or simply speaking, that is used for buying goods and services. Easy, we're good on this. Goods and services. Okay. Now, this being said, back in the day, money was only the cash that is used to buy goods and services, right? Back in the day, the only form of money that humans had was the cash, right? The currency notes. I'm not going very much back in the history, because we know that even before currency notes, we used to use goods and services to buy other goods and services. That was barter system. You must have studied all of this in your AS economics, right? So let's not go over there, but we're just talking about that few years back, it was only the cash or the currency notes that used to be the only form of money. But now, money not only includes cash or currency notes, right? It also includes the bank loans, because think about it, with the loan, you can pay uh, any person, right? Think about credit card. So credit card is kind of a loan, right, that you've taken from the bank, right? So bank loans, right? Currency notes, right? So all these things are, so these are part of money now, right? Okay. Now moving forward, think about this. Since we know that the ultimate purpose of money is to buy goods and services, since we know that the ultimate purpose of money is to buy goods and services, what we need to think about that the stock of money should rise in proportion to available goods and services. Let me repeat this point again. Okay. Since we know that the ultimate purpose of money is to buy goods and services, therefore, the stock of money that's available in a country should rise in proportion to the stock of goods and services that are being produced. Is this making sense? Otherwise, what? Let's think about this, right? So if money supply is increasing, money stock or money supply, whatever you want to call it, right? If money supply of an economy is increasing more than is or increasing faster than the stock of goods and services that is available for it to purchase, then more money will be chasing fewer goods. I repeat, If the money supply in an economy is increasing faster than the supply or the production of goods and services, then basically more money will be chasing fewer goods. And with that happening, right, what will that do? Any idea? When more money starts changing, so this thing over here is increasing, and the stock of goods and services is not increasing as fast, right? So money stock is increasing, money supply is increasing faster than the stock of goods and services, right? So now when more money is chasing fewer goods, what will that do? It will bid up the prices. It will cause inflation, right? So do you remember, you must have studied in your ES economics the idea of inflation as monetary phenomenon. More money, right? So when more money is chasing fewer goods and services, it causes monetary inflation. Is it making sense, right? And the prices of goods and services will rise. It will cause monetary inflation. Any confusion so far? Anything that's not clear? Anything you want to ask me? Right? We good? Okay. Now, this being said, this is exactly the idea what, great. This is exactly the idea what quantity theory of money will explain. So it's a very simple equation, which I'm about to write in front of you. So it says MV is equal to PT. MV is equals to PT. Now, what is this, right? So I'll explain you each of these four variables. So MV, the two variables, M times V, you can also write this down with a dot because it shows that the two variables are being multiplied, right? And similarly is equals to P times T. Okay, now let's have a look at this. So M here is referring to the money supply of an economy, right? So M here is referring to the money supply in an economy, right? So V here in this equation is referring to velocity of circulation. I'll tell you what this is. Velocity of circulation, right? The P in this case is average price level through which we measure the inflation of a country. So P here is average price level, and T is the number of transactions. T is number of transactions that take place in an economy during certain period of time. Number of transactions. Okay. Now think about this. The left side of the equation shows the money supply that is available to buy goods and services. Right. Okay. Okay. So we can continue from here in tomorrow's class. Fine. So let's stop here for today. And then tomorrow we'll continue from here, from quantity theory of money. So just quick thing. So after that, I'll see there might be some smaller topics left within A2 economics syllabus, but we are done with all major ones, right? And then hopefully we'll complete off with the smaller topics. Today is Wednesday. On Thursday and Friday, we'll complete off with the smaller topics. And then hopefully over the weekend, we'll start off with the past paper practice. And do message me the exact dates for your exam, right? That will help us to better, better prepare and better plan. Okay, thank you. Have a good night. Bye.